Well, Jaginder Rana here. The topic of the day is important insurance ratios. Important insurance ratios. As the awareness of the importance of insurance is growing rapidly, and insurance companies are introducing new plans to the market meeting the requirements of people of all ages and professions. So it is important to identify the important factors which influence your decision making. It may seem that all insurance companies offer similar policies with little to no difference in premium and coverage, and it conflicts with the customers regarding which insurer to pick. So various ratios on which insurance companies can be compared and can help the customers to make an informed decision. These parameters can help to assess an insurer's profitability, efficiency, and overall financial stability. So let us say the 6 key ratios which can be used by customers to form an impression of any insurance company. The first one is persistency ratio. As the name suggests, the persistency ratio indicates how many policy holders persist in a given period. Usually 1 year. It is the ratio of active policies, policyholders paying premiums, and the total number of policyholders. If an insurer does not meet customers' expectations regarding claim settlement, customer support, post-sale service, etc., policyholders will eventually stop paying premiums. Hence, this ratio determines the customer satisfaction from an insurance company. The higher the persistency ratio, the higher the customer satisfaction. So, formula for persistency ratio is number of policyholders paying premium upon net active policyholders into 100. Persistency ratio formula is number of policyholders paying premium upon net active policyholders into 100. Favorable range is 85% to 100%. Unfavorable range is less than 85%. Second one is solvency ratio. The solvency ratio determines the financial stability of an insurance company. The Insurance Regulatory and Development Authority of India has made it mandatory for all insurance companies to maintain a 150% solvency ratio to ensure that an insurer fulfills its obligations to provide claims to policyholders in case the company goes bankrupt. So in simple terms, it is fair to say that the solvency ratio determines if the company has enough funds to settle claims in the most extreme cases as well. So higher the solvency ratio, the lower the risk of company not being able to provide a claim. Now the question is how to calculate the solvency ratio. The formula is solvency ratio is equal to net income plus depreciation upon liabilities favorable range. Favorable range is above 1 and unfavorable range is below 1. Solvency ratio means net income plus depreciation upon liabilities. Third one is combined ratio. Combined ratio is used to define the profitability of an insurance company in terms of its operations and businesses. So the combined ratio also indicates how effectively a business makes use of its resources. If the combined ratio is less than 100%, it implies that the company is making profit by getting more premiums than paying claims and other expenses. And if the combined ratio is more than 100%, it means that the company is in loss by paying more claims and expenses than collecting premiums. So combined ratio depend on various factors like agent commissions, staff salaries, and various other operational expenses. The formula to work out the combined ratio is combined ratio is equal to expense ratio plus underwriting loss ratio, where expense ratio is equal to underwriting expenses upon net premium earned. So favorable range is below 100%, unfavorable range is above 100%. Then the fourth one is incurred claim ratio. The incurred claim ratio is the ratio of the net claim settled and net premium collected. It reflects the financial situation of an insurer. The RDAI has made it mandatory for general and health insurers to publish their incurred claim ratio in the annual report. A low incurred claim ratio means the insurer is in a strong position as it is collecting more premium than paying claims, whereas an ICR of 100% means the company is at risk as the premiums getting collected are exactly the same as claims being paid. So the formula for incurred claim ratio is net claim settled upon net premium collected. Favorable range is 50% to 100%. Unfavorable range is below 50% and above 100%. Then comes claim settlement ratio. So claim settlement ratio determines the relationship between claims filed and claim approved in a given time period, usually a year. It indicates the claim settlement efficiency of an insurance company. Higher claim settlement ratio ensures a policyholder's trust in the company. The higher the claim settlement ratio, higher the chances of getting a smooth, hassle-free settlement. Formula for claim settlement ratio is total number of claims settled in a year upon total number of claims received in a year into 100. So favorable range is 85 to 100%, unfavorable range is less than 85%. And then commission expense ratio. So the commission expense ratio defines the commission paid from the written premium during a particular period. So you must check the commission expense ratio as it influences the premium paid by the policyholder. A low commission ratio is in favor of policyholder, as the lower the commission ratio, the higher is the discount offered, which leads to a lower premium. The formula to work out the commission expense ratio is total expenses upon average value of the portfolio. Favorable range is below 20%, unfavorable range is above 20%. So apart from basic parameters like premium and coverage, there are various other factors that should be considered before purchasing a policy. So these six key ratios determines the financial stability, customer satisfaction, profitability of the insurance company. Insurance companies can be compared to each other on the basis of loss ratios, which enables customers to make much more informed decisions. These ratios are used to evaluate an insurance company's performance, business and finances. You can determine a company's customer satisfaction, claim settlement and financial stability by analyzing these ratios. It enables customers to make a well-informed decision. So customers can use these ratios while they are confused on which insurer to pick. One might be getting a very similar policy from different insurers. So these ratios will help in clearing the dilemma. These ratios are generally calculated annually, but some of them are also calculated quarterly. Some of these ratios are published in annual report as well. Customers should prioritize claim settlement and customer satisfaction while looking at these ratios. So the combined ratio, also called the combined ratio after policyholders dividend ratio, is a measure of profitability used by an insurance company to gauge how well it is performing in its daily operations. So the combined ratio is calculated by taking the sum of incurred losses and expenses and then dividing them by the earned premium. The formula for combined ratio is equal to incurred losses plus expenses upon earned premium. The combined ratio measures the money flowing out of an insurance company in the form of dividends, expenses and losses. Losses indicates the insurer's discipline in underwriting policies. The expense ratio gauges the efficiency of an insurer and how well it uses its resources to drive top line growth. So the combined ratio is arguably the most important of these three ratios because it provides these six ratios because it provides a comprehensive measure of an insurer's profitability. The combined ratio is typically expressed as a percentage. A ratio below 100% indicates that the company is making an underwriting profit, while a ratio over 100% means that it is paying out more money in claims that it is receiving from premiums. Even if the combined ratio is above 100%, a company can potentially still be profitable because the ratio does not include investment income. Many insurance companies believe that the combined ratio is the best way to measure success because it does not include investment income and only includes profit earned through efficient management. So this is important to note since a portion of dividends will be invested in equities, bonds and other securities. The investment income ratio, investment income divided by net premiums earned, takes investment into account and is used in the calculation of the overall operating ratios. So the combined ratio is a measure of profitability used by an insurance company to gauge how well it is performing in its daily operations. The combined ratio is typically expressed as a percentage, and a ratio below 100% indicates that the company is making an underwriting profit, while a ratio above 100% means that it is paying out more money in claims that it is receiving from premiums. Many insurance companies believe that the combined ratio is the best way to measure success because it does not include investment income and only includes profit earned through efficient management. So the difference between combined ratio and the loss ratio is there. The loss ratio measures the total incurred losses in relation to the total collected insurance premium, while the combined ratio measures the incurred losses and expenses in relation to the total collected premiums. The combined ratio is essentially calculated by adding the loss ratio and expense ratio. So the loss ratio is calculated by dividing the total incurred losses by the total collected insurance premiums. The lower the ratio, the more profitable the insurance company and vice versa. If the loss ratio is above 1 or 100%, the insurance company is likely to be unprofitable and maybe in poor financial health because it is paying out more in claims than it is receiving in premiums. So the components of the combined ratio each tell a story and should be examined both together and separately in order to understand what is driving the insurer to be profitable and unprofitable. Policy dividends are generated from the premiums generated from the insured's underwriting activities. The loss and loss adjustment ratios demonstrate how much it costs the insurer to offer $1 of protection. So the expense ratio shows how expensive it is to generate new business since it takes into account commissions, salaries, overhead benefits, and operating costs. Thank you very much.